Welcome to Chapter 8, and this chapter is an update as a result of changes that occurred to the way that we deal with employee deductions in payroll. So this is the first of two chapters we'll be covering on payroll. This chapter will do it from the employee side of things, and then the next chapter will be from the employer side of things. So as it said, basically, you've got to keep good payroll records. You've got to keep payroll records because you are, as a payroll manager, you are holding funds in trust. The money that you withhold from your employees' paychecks actually belongs to the federal government, and you are responsible for ensuring that what you withhold, you properly remit to the taxing authorities. And quite often, payroll managers don't understand that their failure to properly transmit funds withheld from paychecks will fall on them personally. Just because you're an employee for a company and managing payroll does not shield you from individual liability from ensuring that the funds are properly remitted to the government. So making sure that you keep good books and records is critical, as well as probably most importantly, actually remitting that money. So who must you withhold money from? You potentially have two kinds of people that might be obtaining payment from your company for services performed: employees and independent contractors. And it is really important to understand the difference, because if you fail to treat an independent contractor, well, if you treat an employee like an independent contractor, the government can come in, look and determine whether the facts and circumstances support the treatment of that person like an independent contractor. And if they do not, they will recast that person, and it will cost the company a lot of money in order to do that. So it's bad news. So let's talk first about what an employee is. And these are your more common types of folks. They work basically under direct supervision of somebody. They are responsible for the time, place, and manner that the work is performed in. They absolutely have to answer to somebody else, and they don't have a lot of professional judgment in terms of how they execute the work. On the other hand, there are professionals that work by contract, and that often leaves them with a certain amount of flexibility in how the work gets done. Basically, here's a contract, you get the work done. I don't care how you do it, just do it competently. Those folks are generally considered independent contractors. Now, the basic difference between those two in terms of a payroll standpoint is, if somebody is an employee, you are responsible for their withholding, payroll costs, potentially benefits, things like that. Whereas if somebody is an independent contractor, you don't have to withhold taxes from their pay. Quite often, both sides, the employee or the prospective employee, and the employer, would love to treat somebody as an independent contractor. The independent contractor gets their money in cash with no taxes withheld, which often can be a curse later come tax time if they don't properly make estimated tax payments. But then the employer also saves on the employer's side of the tax, which we'll learn more about in the next chapter. So as tempting as it may be to classify an employee as an independent contractor, just to understand that there are significant consequences for doing that, and going through the formality of having someone be considered an employee. It's a better safe than sorry if you're not sure. How do you calculate employee earnings and deductions? So the first thing that you want to do is look at the total earnings. If somebody's being paid hourly, if they have overtime that might be at a different rate, or maybe they get shift differentials, you have to calculate what their total earnings are and then determine the amount of the deductions. Now, those could be insurance, they can be taxes, they could be child support. There could be a wage garnishment from a creditor. So there's all kinds of things that you might have to deduct. You would subtract the deductions from the total earnings, and that's the amount of pay that actually goes to the employee in their paycheck. So often, again, another way that companies sort of, I think, take advantage sometimes of workers is that they try and categorize someone as a managerial type person that would be subject to a salary. And why is that beneficial? Well, it means there's no overtime. It's a flat number of hours per week. And if the employee is forced to work beyond that because of the nature of their supervisory duties, they don't get paid any extra. On the other hand, if somebody is truly an hourly person and an employer incorrectly categorizes them as a managerial salaried type person and doesn't pay them the proper overtime that they're entitled to, that could give rise to a wage and hour claim. So, be real careful. Certainly paying somebody hourly as an employee is the safest way to go. The Fair Labor Standards Act requires 1.5 times for anybody that works over 40 hours in a week, except, again, as it indicates, salaried folks here. So basically, again, computing the total earnings, you take each number of hours worked at each specific hourly rate and you multiply those out, and then that becomes the hourly rate. Now, it's interesting. My daughter has a summer job, and she works at a facility where she works in 2 different capacities, and she gets paid 2 different pay rates for those. And often they don't appear to be paying her all that she is entitled to for the hours worked in a week. And if you look at her pay stub and it says rate of pay per hour, it says various. And it's really quite troubling to not be able to look at the paycheck and say, okay, 15 hours a week at $16 an hour and 10 hours a week at $13 an hour. That's really what it should say. If you want full transparency and you want somebody to be able to legitimately track the hours that they work, and you want to reduce the number of phone calls you're getting from employees saying, I can't figure out, my paycheck and why it came out to this, give as much detail as possible on the pay stubs so that you're not making it unnecessarily confusing. So in our first example, we have Helen Kuzmic working 54 hours a week at $14 an hour. Helen worked 4 hours on Sunday. She gets time and a half for regular hours in excess of 8 Monday through Friday, and she gets extra on weekends. So she's got $14 an hour times 1.5, which would be her overtime rate. And that gets her to $21 an hour. And then she's at double time for her Sunday work. So how much does she gross? 40 hours a week at 14, 10 hours at 21, 4 hours at 28. And I think you can see if you're Helen and all you get is the gross pay at the end, unless you're keeping meticulous records of your own and the various pay rates, sometime, it might prompt a call to your payroll person to say, I don't understand this, or how did you pay me? So all this detail is really helpful to both sides. Now we've got Lynn Swaney. She's salaried and she gets $2,600 a month, but she gets 1.5 times her regular hourly rate for anything over 40 hours a week. So she gets her $2,600 a month, which calculates to $31,200 for annual pay, divided by 52 weeks. That is $600 per week. And then we can break that down into hourly to calculate the time and a half for overtime. So this employee had her regular salary for this week of the $2,600. the overtime, and then the additional. As an employer, you are obligated to accurately calculate the withholding tax and then deduct that. There are federal withholding taxes. There's not in New Hampshire state income tax, but there is in Vermont. And then some municipalities have local income tax as well that has to be withheld. There is FICA withholding, which is short for Federal Insurance Contribution Act, and that's actually made of two separate calculations, Social Security and Medicare. Way back in the day when I first started working, those were combined into one calculation, but they've now split those into the Social Security and the Medicare separately. You could also have certain voluntary deductions. You could have health insurance. You could have maybe somebody's making payments into a savings account, so they've got some money going into a checking account, some money going into a savings account. Somebody could be making their car payment even out of their paycheck if that's something that you allow. So the gross pay less any deductions is called your net pay or take home. The federal income tax is based on marital status, household size, earnings, and the number of allowances claimed. This can get a little, this varies a little bit, again, for somebody who's married and has a spouse that is employed versus not employed, or if somebody's got a second job. They will need to calculate that. So how do you know for each employee how much to withhold? And the answer is that the employee completes a federal form W-4. And I will just stop this and go over to the form. So here is an example of the federal W-4 for the year 2020. And this is the worksheet basically that the person will calculate. This form has the ability, unlike the old form, it takes into account things like second jobs so that it ensures that you're not, because because income tax is calculated based on your total wages. If you've got two employers and employer A is withholding as though that's your only job and employer B is withholding as if that's your only job, yet combined they boost you into a higher tax bracket. If you don't properly fill this form out so that each employer is withholding at a higher rate, taking into account the other job, you're going to end up owing come tax time. And that's something that folks often lose sight of and they think they're getting this big refund because they filled the form out right. They just forgot to properly calculate in what they were being paid from their other job. Here's a short form example W-4 from your book. It doesn't have the full calculation that the actual form has, but I want to draw your attention to the number of allowances that Mr. Ken M. Eyestone claimed. And he claimed 4, and he is married. And you will use this to then determine how much he should get. So Ken's got $640 per week. He's paid weekly. And so you're going to go to the weekly. There will be multiple payroll tables in this circular ebook. So you have to make sure that you find the correct one. So you're looking for one for a married person, and you're looking for one that is for a weekly payroll cycle. And so then all you do is you go across the top to the number of allowances. But again, you've got to make sure that you are on the correct tax table if you're doing this, because it's easy to inadvertently choose single weekly, or example, if you're not paying attention. And they're all in this little book together. So you then go down the salary, the wage column to the left, and if it's between, find the points at which the wage that he's being paid falls between, you follow that over to the number of allowances, and this is how much $10 he is to have withheld for federal income tax. And again, this is an old tax table, so this is just an example. Now, that isn't the only federal tax that has to be calculated. We also have to calculate Social Security and Medicare, but those are more or less standard rates. Um, and again, there are some exceptions to this, but for Social Security, it is 6.2% up to, and this changes annually, so this is slide's a little bit old, so this is no longer accurate, but 6.2% on the maximum earnings. And again, this number changes every year. And once the employee hits that earning level during the year, then the employer can stop calculating Social Security on the employee's earnings. However, Medicare, which is 1.45%, applies to all earnings. So once in a while, Congress will do something to change this percentage if they want to do a stimulus, but otherwise, this 6.2% is your standard. So we've got Sandra Cadrain, and she has earnings of $2,000. And so her year-to-date earnings are $127,340, and so because she has not reached the maximum of $128,400, she pays Social Security on all of her earnings plus, so once she again hits that cap, she will no longer pay it, but because she's not there, she pays the Social Security as well as the Medicare tax. And I'm going to stop this video here and go on to the next one for voluntary deductions.